we'll kick things off. Very excited to have Rayanne here with ABC Solutions. We're going to talk about some year-end tax planning and year-end accounting strategies. Critical thing for all of us. While we should be focused on this every month, right, Rayanne? It seems to be that we decide that it's important as we get towards the end of the year. Better late than never. So, it's always just a critical thing. I mean, there's money often that we're leaving on the table. There's, you know, just different preparation practices that, if not put in place, ends up costing us more during the tax preparation process. There are so many different ramifications, much like we educate our clients on the IT side from a security perspective and just overall, proper IT hygiene. We need to look at different business functions, and accounting and tax is such a critical one for us as business owners. With that being said, I'm going to turn it over to Rayanne, and we'll kick things off right now.
Thanks, Dan. I really, really appreciate the opportunity to come in and chatting with everyone. And I can see a few people on this call, and I know that there's at least one or that I owe a tax projection to. So, by the way, that's coming really, really soon, like in the next week, just so that you know. I have a couple of slides. I'm not going to kill you guys with slides. I only have a handful, but do you mind if I share?
Yeah, absolutely.
Um, hang on, people are talking about a key that I have. I have it. Sorry about that.
No,
Okay.
no problem.
So, who am I? Why am I here? So my name's Rayanne Buccianico, and I think I feel like I know all of you that are here. So hopefully you know who I am too. I own ABC Solutions in Clearwater, Florida, and we help MSPs with their accounting, their tax, and their finances, and their business growth, and so on and so forth. So that's who I am. All right. There's a couple of things, when Dan reached out a couple of weeks ago asking if I could put something together, I thought, what are some of the things that I really want to talk about? And one of the things that these are the four that jumped out at me right off the bat. I ran into a situation about where I with a client, and they expected that they could sell their business, and as long as their income stayed under a certain amount of money, they would not have to pay any capital gains because, they were, everything you read indicates that as long as your other income is under a certain dollar figure, there's 0% capital gains rate built just for you. And so I want to kind of walk you through that fallacy and what the real rules are so that you don't get, you don't get hit with taxes that you're not expecting. I also kind of want to talk about the retirement plans. Can you guys see my screen okay?
Mm-hmm. Yeah.
Okay, good. I want to talk about retirement plans because this is one of the areas where you can afford to put some money if you have cash. If you can afford to put some money into your own pocket and save a few tax dollars. And some of the rules around that. I want to talk about the Corporate Transparency Act, and then some business tax updates. All right. Is there anybody here, on this call that has some capital gains that are coming at them this year? And don't feel like you have to, share that information if you don't want to. But the thing about the 0% capital gains rate is that all of your income, including the capital gains, only the first 47,000, if you're a single person, if you're married filing jointly, it's 94,000. But the minute that your income exceeds that magical number, then you're going to get kicked into the next capital gains rate. And then when you exceed this number, you're going to get kicked into that next capital gains rate. So in the case of this one client I had, they sold the business, and their gain was going to be $1.7 million. And they were like, this is great. Sold it early in the year. I don't have any other income except for a little bit of a pension income and some, interest and dividends and my Social Security and blah, blah, blah. And so I can easily stay under that $47,000, and I'm not going to have to pay any tax at all. I'm like, hang on, it doesn't quite work that way. So, so if you had zero income and your total capital gains was $47,000 and you were a single person, sure, absolutely no tax, good for you. But if you've got, $1.7 million, right? So the first 47,000 is going to be taxed at 0%. The next 250,000 is going to be taxed at 15%. And then beyond that, it's going to be taxed at 20%. So don't fall into that trap, right? And to my client's credit, everything I read that they were reading on the internet from the IRS, from, Forbes magazine, the whole bit, none of them spell that out. And so it can be really, really dangerous if you are relying on that 0% tax rate for a much larger gain. So
it's tiered out like that. So if you make 50 grand, you're not going to have to pay 15% on 50 grand, only the extra 3.
Correct.
Okay.
And so for this client here, since it was 1.7 million, unless they wanted to wait 50 years to get all that money to try to defer it, the best they could do it'd be to take 290,000 each year if they had a way to defer accepting that money.
Okay.
And that would lower it slightly.
So I think what Mike is suggesting is something like selling the business on an installment plan that would pay a certain amount of money each year that, could keep it at a 15% rate. Yes.
You could, but even then you'd only be saving 5%. And if you could be making 12% on it.
Exactly.
It's not a good strategy.
Most people just want to rip off that bandage and, pay the tax and move on with life. So, and I tried a couple of different scenarios where, well, what if we were to, take a loss on the business, right? Because if the business doesn't exist anymore, it's going to be a deductible loss. So, what if we took a loss on the business and increased, by increasing expenses, by creating a salary, and what could we do with these things? And none of it made any real significant difference. So anyway, I just kind of wanted to point that one out. All right, the next one, there's a couple of things, and I didn't get a chance to type up a separate slide, but there is something else besides this I want to talk about. When I'm looking at a client, when I'm looking at a set of books, and I see that there's, a lot of money in net profits at the, for the year, I immediately begin asking myself, how can I reduce the tax burden to this business owner and let them keep more of their money? And one of the things that I always bring up first is retirement plans, because the retirement plans, it gives you the opportunity to suck aside a lot of money into your retirement plan, pre-tax if you choose, and in allowing you to keep more of your money and paying less in taxes. It's not a dollar for dollar tax savings though, right? You're reducing the income, not the tax dollar. So I thought I would put it out there. The 401k, if you're looking to max out your 401k this year, it's $23,000. If you're over age 50, like some of us older people, you can tack on an additional $7,500. And I feel like, yeah, right. So it's 7,500 for the catch up. Simple IRAs. We like the simple over the 401k. Sure, the maximum contribution's just a little bit less by a few $1,000s, but you also don't need an administrator. You don't have to file any taxes. Simple IRAs just are simple, right? So, you can set it up yourself. You can, you can manage it yourself. It's just easy to do. And it's, and it's a good benefit for your employees. If you have employees, you can offer it to them. If you participate, you have to offer it to everybody. If they choose not to participate, you don't have to do a match, right? So you're only matching up to 3% of their salary. So you're matching dollar for dollar their contributions, maximum 3% of their salary. It's a nice benefit, and allowing your people to save some money for retirement for themselves. Now, I want to talk a little bit about the traditional IRA and the Roth IRA. You can both have a $7,000 maximum contribution with a $1,000 catch up for if you're over 50. However, see this phase out? Now, these phase outs only apply if you are also contributing or participating in an employer-sponsored plan. So if you have a 401k, and you max it out there, then you can also put additional money into a traditional or a Roth IRA up to these limits, as long as your income stays under a certain amount. So if you're a single person, that amount is only $77,000. And that means that, so if you have $100,000 of income and you're a single person outside of, if you're already participating in another plan, you cannot put additional monies into an individual IRA. And a lot of people overlook that little rule. And sometimes I find out about it too late. I'm doing the tax returns and say, oh, did I tell you I put $7,000 into my Roth? But hang on, you have a 401k at work, and now I need you to take that money out. And I hate telling people to do that. I literally loathe that. So, make sure that you know where you stand. And these are the so this is the low end 77,000 for the single person. Oopsie. And it completely phases out to $0 when you hit that high end of 143 of married filing jointly. I didn't put all of those different phase out ranges for each of the filing statuses. Just know that they are there and where you fit in them. And then the Corporate Transparency Act, I don't need to go into all of this information because I'm happy to answer any questions, but the Corporate Transparency Act, or the Beneficial Ownership Information Filings with the Financial Crimes Enforcement Network, went into effect on January 1 of 2024. And they gave existing businesses 12 months to comply. So that clock is ticking. If you have not done your BOI filing and you're still in business and you make under $5 million in revenue, go out to the Financial Crimes Enforcement Network and file your beneficial ownership information, the BOI filing. As soon as you go to fincen.gov, fincen.gov, literally it's going to be a big button, right there. for you to file. It's not going to cost you anything, but you've got to upload your driver's license or your passport and give them your name and your date of birth and probably a social security number or something like that. And this applies to anybody who has any beneficial ownership in your company, right? So, and it doesn't even necessarily need to be an owner of the company, just somebody who controls the money. So if somebody has signature authority on a bank account, could be your wife, could be a bookkeeper, could be somebody, you've got to report them as a beneficial owner, even though they don't own any stock. Does that make sense? So I can go on to more information about that, but I'm going to leave that for the open discussion. And so just a couple of quick tips on the 2024, your standard mileage rate for business use of your automobile is 67 cents per mile. Business meals are 50% deductible in 2024, and that is slated to expire next year. So that according to the Tax Cuts and Jobs Act, the business meals deduction is expected to go away unless it gets carried to either permanent or extended. So we'll see what happens in 2025. Now, the president that's coming in 2025 happens to be the same one who wrote this law. So let's see what he does with it. Entertainment expenses are not deductible, and they will likely never be deductible again. The Section 179 depreciation. Has anybody here spent $1.1 million in new fixed assets? No, me neither. So, but you'll be happy to know that you can write off that much money. And there is a 60% bonus depreciation. So what I'm saying, what that tells you, like this 60% bonus depreciation should tell you that back during the pandemic and a few years before that, the 100% bonus depreciation was automatic. Anytime you bought something, it was automatically expensed in full up to the full amount of this number. And then, but now Section 179 is back in style because the bonus depreciation is only 60%. So you actually have to make the Section 179 expense election for new fixed asset purchases. Other fun fact not listed here is that fixed asset purchases or large equipment purchases, the number used to be, the magic number was $500 before you had to capitalize it and depreciate it. The new number is $2,500. And so any new purchases, $2,500 or less, you can throw it straight to the P&L and the IRS won't have any problems with that. You may have problems with that because it'll throw your margins off out of whack, but it's certainly legal. And so, with that, I've I'm going to turn it into and ask me anything, and now I can stop sharing so we can chat.
Yeah, it looks like there are a couple questions in the chat that we'll start with. Norm was wondering about, this is in the area of the capital gains, the word long-term. What is considered long-term?
Long-term is assets held longer than 1 year at a minimum. There's a weird 18-month, right? So anything under a year is considered short-term and it's taxed at ordinary tax rates. And then, but some assets, there's a mid-term, which is 18 months. But for the most part, anything above a year is considered long-term.
And then let's see, Joshua was asking about BOI currently on pause due to a court injunction.
There is a court injunction, but they have not stopped the filings. I would recommend filing it just in case. The last thing you want to do is get hit with those penalties, and because those penalties can be steep. And if they do decide that this BOI filing is is allowed, then and I understand why it's on pause or why it's in the courts, because it's very discriminatory. Accountants don't have to file it, but I filed one anyway. Lawyers don't have to file it, banks don't have to file it. And any small business that makes over $5 million in a year in gross revenue also don't have to. So there's an awful lot of exemptions, and they're just targeting us little people. And it's, it's totally unfair.
So I'm rewatching Breaking Bad, so of course this all comes to mind. What can you clarify the purpose of the BOI and what this is being used for, and what the purpose is or the motive behind it is?
Yeah, actually, I do have that part in my in my slides, and I'm happy to share it again. But so the people that are going to receive the information, it's going to be the federal government, the state and local governments, financial institutions, treasury personnel, so on and so forth. And they are doing this because they want to make sure that they know who owns. There's a gazillion LLCs and unincorporated little shell companies, and they want to make sure they know who owns them in case money starts leaving the country. So that's why it's at fincen.gov. It's the Financial Crimes Enforcement Network. They want to make sure that if money is leaving the country, they know who is sending it and where it's going.
Okay.
And that's really all it's about, because anybody can, spin up a new LLC tomorrow, go to your state the Secretary of State in your state, and create a form, go to the IRS, get a tax ID number, and, voila, you are in business, and open up a bank account and start laundering money to heart's desire. So, and they're just trying to put a quash on that.
And then, so this again is not only the business owners, but also any kind of key holders. So if you have someone that's an office manager that has access to, let's say your QuickBooks and your banking sites, and they're maybe making payments, withdrawals, et cetera, they need to be you fill out a BOI as well.
Well, they need to be listed on your filing as
Okay.
as a responsible party, right? They're not an owner, but they're a responsible party.
Now, other than being on a call like this, or just coincidentally last night in my business networking group, the accountant member was talking about this, how the hell are people supposed to know?
That's a really great question. Because it's interesting, because I get these newsletters from the AICPA and the tax people, and I get them from the IRS and all these different places. And of course, there's plenty of spam out there saying, "Hey, did you do your BOI filing yet? Pay us $500 and we'll take care of that for you," or something like that. And there's plenty of people out there trying to capitalize on the latest filing scams. But I don't know how you were supposed to know that.
Ensure that you are connected and leveraging a great resource like ABC Solutions, maybe?
I want to say this is probably the third or fourth time I've brought it up in webinars this year. Like back in January and February, I was talking about it all the time. And then, tax season comes and goes, and so do, hurricanes and storms, and life goes on. And then it's like, oh my goodness, it's November. We better make sure that we've gotten everybody. And so, we've sent out emails and newsletters to our clients a number of times about this, just making sure we don't have to do it for you, but somebody should be doing it.
Well, just the correlation here to us as managed service providers. I mean, there are certain things that we learn about that might be requirements, regulatory, requirements for our clients, and they count on us to educate them, and it's same correlation to whoever you work with, for your CPA, you hope that they've got your back as well and are educating you too, much like Rihanna is saying, sending out emails and they've included in their newsletters. I just think it's just so critical that, again, what we do is so much more than what we do as far as keeping technology running. It's also just educating them about things that they might not be aware of. And if we don't tell them about it, and they find out about it from someone else, they're gonna be like, wait, I thought you had my back. So just an interesting correlation, going from, the finance to technology. So
It's a solid point though, Dan. When I talk to some of my clients, they know more about, the cybersecurity regulations that I am required to have in my business than I do sometimes. I'm like,
sure.
is that I was supposed to do? Like, let me
Right.
down so I can just double check, thanks for the tip. So
Yeah.
yeah, I learned so much from that. I learned so much from you guys. You don't even know how much I learn from you guys on a daily basis. So
And yeah, yeah. And then Norm's got a question about this is a great question about purchasing another vehicle or a new vehicle, and whether the business should buy it or not.
and that's a very popular question, probably every year. Okay, so Norm, here's the rules. So I'm going to tell you what the rules are, and you can do with that whatever you'd like. If the company buys the car, the company can write the entire car off. You want to make sure that the business use of that vehicle is going to be at least 50%. If it's underneath 50%, you're running into the risk of like, why does this company own this vehicle for other than to get this, $30,000 deduction, which by the way is the luxury auto limit for this year. Anyway,
Would that 50% include driving to the office and home?
that's commuting. That's not business.
All
Sorry.
right.
But that was a great question. Everybody, that's another one I get all the time too, right? So that's commuting. But also any personal use, if the company is going to write off the car, any personal use, let's say 60% business, 40% personal, then the human being has to report to the company how many personal miles they drove that company owned car. And then the company is required to convert those miles into dollars and stick it on your W-2 because you don't get a free car. So it has to be reported as wages. You want the company to deduct it, then personal use has to be reported as income to you. Now, if you purchase the car personally, there's a couple of things that you can do here. One, your auto insurance is going to be less because it's not commercial, it's individual, right? And two, you can take your business mileage, submit an expense report to the company, and get reimbursed at 67 cents per mile for the business use of the car. And that has no tax. That's an expense to the company without any income ramifications to you, the individual. So if I had my choice, I'd say if this was going to be primarily a personal vehicle, or close to 50-50, I'd probably buy it personally and then submit the expense reports for the mileage. That's what I would do.
Do you have to get reimbursed for those miles from the company as an owner, say? Would I just be able to, add that amount up and put that as a deduction?
Sure, right. And then you would push, so in order to create the deduction, you'd have to debit the expense and something has to get credited. And so usually what I would do in that case is reduce any profit distributions or shareholder distributions. And I would push the credit through the equity section.
That would be like an owner investment then?
Yes, exactly.
Okay. Okay. And then how about this though? So if you buy it as a personal car, but you decide to wrap it or put your logo on it, and you're taking advantage of it being lower cost insurance, but you get into an accident, and maybe this is more of a legal question than anything. But if you get into an accident, then isn't the possibility of them suing both the business and the personal there? So,
I'm gonna go with yes on that, but I'm not an attorney and I don't play one on television.
yeah, yep,
That's a Brad Gross question.
yes,
That's definitely a Brad Gross question.
yep,
But
Well,
you
going
know,
back to the mileage
go
piece
ahead.
of it, um, years ago when I had a home office and didn't have an office in the town where I was providing most of my services, I used an app called Mile IQ.
I still use it.
Okay. Then when I got the office and something changed with the app, I forgot what. I was like, yeah, it's not worth it because most of my
Microsoft sold it
clients,
too.
what's that?
Microsoft sold it because it used to be part of the Microsoft suite with 365, and then
Yeah,
they,
I remember that. I was just going to
yeah,
ask that because I thought it was part of that.
Yeah,
yeah,
that might have been. Yeah, so I stopped using it. And then I was like, okay, well, Google has this timeline feature where you can have it show your trips. And then I'm like, I know where my clients are. I pull up the map and I click on it and tells me what client, and then I see what dates I was there. And I'm like, it's manual, but as rare as it is for me to visit a client that's outside of, 5 minutes from my office, that'll work. Um, Now Google took that feature away from being able to pull up your timeline on a desktop computer. You can only do it on your cell phone now.
mm, of
And
Oh,
course,
I'm not poking around my cell phone for that.
how people can work on a cell phone. Like
yeah.
I know people run their entire lives, including business, on a cell phone. I'm like, I don't even know how you do. I need my big screens. I need
All
my
those young whippersnappers, I tell you.
Yes. Okay, so you're all with me on that one.
Yeah,
So
me
does
too.
It
anybody
looks
have any good options now?
like
You said you're still using MyIQ?
I am. Josh says, look at Bouncy. It plugs into your vehicle, ODB port, and has its own cell connection, reports all trips. So thanks for the tip.
Yeah,
Uh,
Yeah.
yeah, that's awesome.
also,
directly to the IRS.
I'm also going back to Breaking Bad as I see, like comments like this, the whole tracking, and so sorry, I digress.
Yeah.
um, and I want to say that QuickBooks also has a mile tracker. They used to have a Mile IQ plugin, but I think that it's now changed, and it's probably because it was sold. But anyway, if you're using QuickBooks, there's a mileage plugin there, uh, and also the QuickBooks Self-Employed has, which is cell phone based, that has one as well.
Okay.
So I want to jump in one question. When we talk about capital gains, other than selling your business, what are some other capital gains that you might experience?
Okay. So because this one comes up a lot also. As a matter of fact, my father called me and he was like, I dumped some, worthless stock and I'm gonna have this big loss. And, should I sell something at a gain so that I can offset it? He's 86. He doesn't want to carry forward 20 years of capital losses at $3,000 a year, right? So um, so we kind of talked through it. Like he's got dividend income and investment income, and at the end of the year, those investments often have capital gain distributions when they pay out their dividends on December 31st. And so sometimes they can be, quite high. Or so if you know that you're going to have a capital, like a real big capital gain, and you have, a stock that's been tanking, like, no offense, Zoom, right? Like, I'm never getting my money back out of Zoom. And so, if you strategically, plan to take those hits and just dump poorly, performing stocks, then you can use those losses to offset other gains. So the way this works is capital gains and capital losses can offset each other. And like rental income and partnership and S corporation income, those things are considered passive. So passive income can be offset by passive losses. So if you've got a real estate property that's losing, and you've got business like a pass-through entity that has income, so you can offset those losses against that income. Of course, there's also passive activity loss limitations that you have to contend with, but generally speaking, ordinary income can be offset by ordinary losses. Passive income can be offset by passive losses. Capital income can be offset by capital losses. They cannot cross. There's no cross.
Where do gambling losses fit into that?
Yeah, gambling losses can only be deducted to offset gambling income. But the problem is gambling income is ordinary. Gambling losses is an itemized deduction, so you're screwed.
Good thing I'm not a gambler.
Right. Yeah. Just for like, I mean, you just play with like goldfish crackers, right? Yeah. So
And
what,
dice.
like, I mean, with in the business itself, though, I mean, unless you're, I mean, because I mean, if you're selling an asset, I mean, most assets in the business, I mean, you're probably not going to be having a gain unless maybe you own office property and you're selling that and you decide to, maybe start leasing instead, or you sell your office property and you decide to have everybody work from home. Are there any other business related ones that, really come to mind, or probably not?
So here's a really interesting, and this one actually hit me the last couple of weeks ago. I had a client sold property. It was a farm in Indiana. They sold a farm that has been in the family forever and ever. Huge, huge gain. And but it was also their personal residence. And so the client comes to me and says, "Hey, we sold this huge, and we got a huge gain. What can we do and to reduce this tax?" And I was like, "Well, hang on a minute. That was a farm. Farms are businesses. What if we could do a like-kind exchange? And you'd have to, identify and purchase another property. Now, it's not going to wipe out the gain. It's just going to kick the gain down the road, until you sell the like-kind property." And everything was going really, really well until we reached out to the what do they call that? Mediator or intermediary. And they were like, "Hey, this would have been a great plan, but the problem is that you had to call us before you sold the other property. So be careful.
Yeah.
If you've got business property and you think that you're going to have a huge gain on it, and you want to do something else to not pay tax on it, start thinking about that like-kind exchange option before you sell, so that everything can be set up and put into place. Even if you can always decide not to roll it over into another piece of property later, but better to have it there and ready than to not have the option at all. So something to think about. I don't know if that answered your question, but I do want to touch on a couple of other things, right? Because we're in the middle of November, And you guys should start thinking about what's going to happen, for your business in 2025, and also what your income taxes are going to look like. So you start to do like a little bit of a tax projection, and you say, and by that, what I mean is take the income that you have for this year, pretend it's March 15th and you're doing your tax returns, right? Put the information into a fake tax return for 2024, do it today and see what it's going to come out to look like. And if you need help with that, give us a call. But, if you know how much you're going to owe on March 15th or April 15th, and you know that today, you can do some things about it, right? Like you can max out your 401k, you can bonus yourself, and take a bonus paycheck and put, a large 90% of it and pay it into taxes so that you don't get hit with a penalty for not making estimated tax payments. So there are things that you can do, but you only have about 45 days to do it. So, yeah, take a look at what's going on in your business, get your books up to date, make sure that you know how much money you've made year to date, and estimate what your taxes are going to be. And then, if you want to buy that new car, Norm, get out there and do it. And maybe that's going to be the deciding factor as to who owns the car, right? Like if you need that $30,000 deduction, and you'll pay the piper next year on the personal use of that vehicle, there's always that option too. So, new equipment, if you want to increase your income and encourage your customers to pay you a year in advance or a few months in advance or something like that, encourage them to buy some equipment at the end of the year to get those tax write-offs. Another tip, if you're a cash basis taxpayer, pay your bills, write the checks to your vendors on December 31st. I don't care when you mail it, just date the checks. And on December 31st, right? So it has to be written, and out of your bank register, not the bank account, but the register by the end of the year.
Let's flip that around. So if you're billing your clients a month in advance, so many are billing, like say it's December 15th for January's monthly service. You receive that money still in 2024 for services in 2025. How are you going about, deferring that income to the next year?
Well, if you're an accrual basis taxpayer in the business, it's a piece of cake, right? The invoice is dated July or January 1. You're not going to pay taxes on it because accrual-based taxes or reporting is done on the date of the invoice. However, if you're a cash basis taxpayer, turn off your auto pays and wait until January 1 to collect that money, because as a cash basis taxpayer, you're paying tax on the money that you collect regardless of when it's invoiced. So yeah, don't collect that money if you're looking to defer revenue.
Same thing too for projects that might carry over from the end of December into January. For more long-term projects, we always have something set up where, we bill like every 2 weeks if it's going to be a longer term project, just so that we're, keeping that cash flow coming in. But, obviously you don't want to, be having like a whole ton of labor hours carried over to 2025 for work that you did in 2024, right?
Right. And again, it comes straight back to the cash versus accrual.
Okay.
If you collected that money and you're a cash basis, you're paying the tax on it, even though you haven't performed the work. On the accrual basis, if you've invoiced for it, if you're an accrual basis, then you can absolutely stick it on the balance sheet into deferred revenue, and that's where it's going to stay. If you're a cash basis and it's sitting in deferred revenue on your balance sheet, your tax person's got to move it. It has to move to the P&L to clear out. And then they'll put it back on January 1 so that you can continue on, your regular books, right? Like what
Yeah.
happens on your tax return has very little to do with what actually happens inside your business.
Norm's wondering if you only do business with MSPs.
Primarily, I would say we're about 85% MSPs around the country, and the others are local small businesses that have been with me for 15 or 20 years, and we just continue to help them.
Much like when I call Brad Gross, the attorney to the stars or attorney to the MSPs. Rand is the same. That's how I refer to Rand. The accounting slash CPA to the stars of the MSPs. So, um, the other thing too is it's going back to Section 179, year-end purchases for computers. Obviously, we should be, and we've talked about this. We've done this in our business, for forever, for decades, for the last couple decades, is putting a big push on trying to get them to replace equipment this time of the year so that they can leverage that tax advantage, especially with Section 179. Now, I want to see if you have any additional thoughts on that, but also if you're doing leasing with clients. It's my understanding, unless something has changed, that if they were to do a $1 buyout instead of a fair market value lease, that they can still take advantage of 179.
Correct. Yep, because that's a capitalized asset. A lease where there's still value at the end of that lease, that's an actual lease, right? You lease a copier for 3 years. At the end of the 3 years, you send the copier back, or you can buy it out just like a car. You can buy it out at fair market value. Most of the time, those copier or printer leases are the $1 buyouts. It's just a camouflaged fixed asset purchase.
Right. So that's a great way to have the ability to, not have a capital expense per se, being able to pay over time. And, oftentimes those leases can be 0% interest. So you've got, a huge advantage there, but then the benefit of being able to write that off.
Right. Yeah. And, it should be noted that, no matter what you buy, if you're financing it, you still get the full amount in year one, right? So, like if you buy a car for $50,000 and well, you're only going to get the $30,000 because it's above the luxury auto limit. So the 30,000 is going to be your maximum deduction unless it's over 6,000 pounds and blah, blah, blah. There's also, by the way, electric vehicle credits, and other, energy efficiency credits, residential energy credits, commercial energy credits. I just put a heat pump into my office building. Cost me an arm and a leg, and probably not going to get nearly that much in my tax credit, but I'm going to take whatever credits are available to me for it.
Yeah.
So, yeah, there's lots of those, and so that's window and exterior window and door replacements. That's heat pumps, water heaters, and they have to be certain grades. Metal roof is solar. The solar energy credits are crazy, which is why a lot of people buy them. You're seeing more and more solar panels because those energy credits like more than pay for the solar panels themselves. We're pretty close. So a lot of people are taking advantage of those.
Other questions out there? We have a few minutes left here.
Looks like Norm bought up an EV. So
Oh yeah.
One thing that I haven't heard you mention is if you have kids and then
Mm.
paying them to reduce, like, I got to
salary.
run this one by my accountant. So we have our kids in private school. So there's tuition to be paid there. if we pay our kids for anything. I've heard examples of like, take some photos for marketing and then pay your kids for the appearance or whatever. Doesn't matter. But they get paid, then you can use that money for their tuition because they're paying their tuition. And now they get taxed in their tax bracket, not yours.
M-
Your
Mostly.
eyes are saying we just entered sketchy town, so.
Yeah.
So yeah, there's a number of people that hire their kids and put them on payroll, and there's some really good benefits to that. You want to make sure that you keep their salaries to be underneath the standard filing, the standard deduction for an individual, especially a child, right? Because you don't want to put your kids in a position where they're now required to file an income tax return. Because if your income is high, and they're filing a tax return, there's something that's called kiddie tax that requires the children to be taxed at the parents' rate. So the IRS is onto you, and that so they've built in these kiddie taxes, and it's been in effect for a long time. Also, if the kids have investment accounts where they're making more than $1,500 in interest or dividends or other passive, investment income, that will also kick in the kiddie tax rates. So because the IRS figures, well, that's just mom and dad hiding money so that they don't have to pay tax on these investments. And most of the time they're right. So yes, and a couple of other things about hiring your children. You can put your kids on salary if you are a sole proprietor filing a Schedule C, or if you're a partner in a partnership that is a pass-through. This does not work for corporations, and it does not work for C corps or S corps. But if you're a sole proprietor or in a partnership, then you are not subject to unemployment taxes. So, a lot of people will take advantage of that, and they'll put the kids on salary, get the deduction, and they won't, they're not subject to things like the state unemployment taxes, disability taxes, the federal unemployment taxes. They're still going to be subject to Social Security and Medicare, but this goes to all family members, children, spouse, parents. You can employ family members if you're looking for a creative way to get rid of some income in your business. But keep your kids under the filing thresholds.
Excellent. All right. We are at the top of the hour. I'm throwing into chat a link to Rand's LinkedIn profile. So if you have any accounting tax needs, Rand is a great resource. So please keep her in mind for that. Rand, as always, we greatly appreciate all of your knowledge and your willingness to get out into the channel and help educate us. So thank you so much for your time.
Very welcome, and thank you for inviting me. I hope to see you guys soon. And if I don't, have a wonderful holiday season, and we'll see you on the other side.
Thanks.
Sounds good. You too.
See you
Thank
later.
you, everybody. Have a great